Welcome, everyone, to another exciting episode of CRE Exchange. I'm Cole Perry, your host and Associate Director of Research here at Altus Group, a leading provider of asset and fund intelligence. I'm joined by Omar Eltorai, our U.S. Director of Research. Together, we'll share the latest news and trends in the U.S. commercial real estate market. Omar, it's great to be with you.
Glad to be here.
Looks like we've got a lot to cover today. So what is on our agenda?
Sure. So we'll first go over some macro releases, including PPI, CPI, business formations, and advanced retail sales. Then we'll touch on some of the retailer earnings, specifically Walmart and Home Depot. And then we have a number of announcements in terms of what to watch coming forward. And we'll also break down really what's happening and some of our views of how to interpret the market and the macro environment that we're seeing.
Well, it's been a busy last few weeks, so I'll let you kick us off. What were some of the things that you were watching in the on the macro release front?
Sure. So I think the first one that got my attention since we last spoke was PPI, or the Producer Price Index. On August 13th, BLS released the July PPI series, which showed that final demand inflation for producers increased at a 2.25% year-on-year pace. This is down from the 2.71% pace that was set in June. This is overall a positive sign that inflation is cooling really throughout the value chain. And I know you also were looking at that release. Was there anything that jumped out to you?
Yeah, speaking of inflation coming back to really normal levels or cooling quite a bit, there's a breakout in the PPI release for non-residential construction, which is obviously the industry we focus on. And so there's a net inputs to industries field, and it has the non-residential construction breakout. And the price of goods rose 0.4% month over month, 0.8% year over year. And prices for services actually declined on the month, 0.2%, but they remained up 0.9% year over year. So I think these are just representing a return to normal inflationary levels for non-residential construction inputs after we saw huge double-digit growth during 2021 and 2022. So I thought that was worth calling out. But, this was a rare case in which the PPI actually preceded the CPI release. I know you took a look at that one. What was going on there?
Yeah, so the next day, so this is August 14th, CPI data was released from BLS, and it showed another positive sign of cooling inflation. Headline CPI clocked in at 2.9% for the 12 months ending July. And this is the smallest increase really since March of 2021, and it was broadly in line with market and economist expectations, which was good. Core CPI, which excludes food and energy, increased 3.2% year on year. This is really still above the Fed's target, but it's also the smallest increase since April 2021. Overall, the combination of a cooler PPI and cooling CPI really helped to drive positive sentiment back into the market and is driving that Goldilocks scenario narrative, and is something that I think the markets had been a bit disrupted by some of the I would say the reversal of the carry trade earlier this month, and we're kind of rocked by quite a bit of volatility, and that brought up a lot of recessionary concerns. However, seeing these positive progress prints from the inflation data, I think really restored that positive sentiment. But moving away from the price indices, I know you were looking at business formations. What did you see there?
Yeah, this is a really interesting data set. I don't know that we've covered it on the podcast before, but this comes from the U.S. Census Bureau, one of their kind of preliminary economic indicators. And this is a release from data from July 2024 on business formation statistics. Came out on August 14th. And it showed that business applications actually declined 2.1% month on month. So they were at a seasonally adjusted level of 420,000. And, these are just applications. So there's also a calculation of how many of these may in the next 4 quarters actually actually form into a business as opposed to just be an application for one. And those actually declined as well, 0.2% month on month. And they were at a seasonally adjusted level of 28,000. Business applications across all of categories have actually started to retreat after a huge surge, kind of immediately during and after the pandemic. And I think they mirror this cooling in employment. So this is, organic employment growth projections. And July actually marked the 6th consecutive quarter of declining projected business formations. So that's a little tough to understand. It's the 6th consecutive, but it's 4 quarters forward looking. But I think this is just a clear sign that entrepreneurial momentum is waning after we had a kind of a burst of this during the Great Resignation of 2021 and 2022. And it reflects a broader economic uncertainty, I think, that could signal some cautious outlooks and might be a bit of a headwind for future CRE demand as well. I also took a look at another indicator this week. This is certainly one we've covered before, and I think one that some of the earnings calls we'll be able to shed a little bit of light on. That was advanced retail sales, also a Census Bureau figure. It's from the Advanced Monthly Retail Trade Survey from August 15th. This is data for July. And this showed that the value of retail and food purchases, mind you, unadjusted for inflation, rose 1% on the month. So from June to July to a seasonally adjusted level of $710 billion, after declining by a revised 0.2% in June. So if you exclude gas and automobiles, which for this particular month is really important because we had the June hack of the software that runs a lot of car dealerships. So there was a pent-up demand in July for new vehicles. So if you were to exclude gas and automobiles, sales actually rose 0.4% month on month instead of that 1% overall in July. So the aggregate data shows that consumers are continuing to spend. This was really well received by the markets, but there are some signs of weakness in there that I think are worth calling out. So I like to call them the real estate intensive retail categories. So there's general merchandise stores. Think about your Walmarts and Targets, Costco's. We'll talk about that stuff a little bit later. And grocery stores. So they are seeing sales rise at an annual pace, but it's underpacing inflation. So this is raw dollar amounts. And so the other one that's worth mentioning is that spending at furniture stores continues to decline on an annual basis. I think that's mainly due to the kind of housing market being as slow as it is and interest rates. And building materials stores actually saw their first annual increase since February of 2023. That's a positive sign, but this is after sustained declines for months. So I think this is a really interesting sign of what's going on with retail. And I think the earnings calls we listened to might shed a little bit of light on that. I know I've been talking for a bit, but there was one more that I did want to call out that came out last week. Another Census Bureau figure released. The new residential construction data came out on August 16th. And so this is about permits, starts, and completions for multifamily, single family, and duplexes and quadplexes. But new permits for multifamily decreased 12.4% month on month and 18.2% year on year at a seasonally adjusted annual rate. So new permits for single family housing were actually down 0.1% month on month, 1.6% year on year. And the number of multifamily units started declined 21.8% year on year and at a seasonally adjusted annual rate. And starts declined 14.8% for single family housing over the same period. So you're really seeing the kind of havoc wreaked by high capital costs, economic uncertainty, The residential supply pipeline for all forms of housing is really starting to trim. And, while potential interest rate cuts from the Federal Reserve might be able to improve financing conditions, the recent surge in multifamily completions is definitely challenging rent growth and markets with a lot of deliveries. So uh, maybe a looming slowdown could ease some of these challenges. I think we still need a couple more months worth of data to tell. But that was a lot to cover there. I think the story that's overarching a lot of this is what's going on with the consumer. I know that there was another release last week that you paid attention to. What was going on with the Consumer Sentiment Index from the University of Michigan?
Yeah, so University of Michigan released the preliminary consumer sentiment index numbers for August, and it showed a slight 2.1% month-on-month increase. So the index ended at 67.8. And this is the first improvement in consumer sentiment since March of this year. So I would say that's a win, or that's positive, and it puts the index at the same level as it was in September of last year. The preliminary August numbers really showed that consumers' expectations for near-term inflation remained stable at 2.9%, and so that's over the one-year period, and at still stable at a 3% for their longer-term inflation expectations, and that's over the next 5 years. The release really can be broken into two subcomponent indices. One which measures the current situation, so asking consumers, how do you feel about the current environment, and then another piece that is asking about the expected future situation. And the August release really showed that consumers are increasingly hopeful about a brighter future ahead, though remain less comfortable with the current situation. So the current index was reported at 60.9, and this is down about 2.87% from July. So it's kind of a worse read than last month, while the expected situation subcomponent of the index increased by 4.79% on the month and ended at 72.1. I think it's good to see the consumers' optimism coming through, though this data still reflects how challenging or how challenged the consumers feel today, which it's a little bit of a mixed bag, but depending on how you want to read that, it's a tough current environment for many consumers, but they think it will get better. The final kind of release that caught my attention was the Atlanta Fed's GDP Now. This is a nowcasting model, right? It's essentially trying to show real GDP growth as the economic releases come out. And so this was released after the housing starts data was released on August 16th. And it is estimating the third quarter, so Q3 2024 real GDP, and that clocked in at 1.98%. And this is the first time that the estimate has been below 2% since the first quarter of 2023. And now shifting attention, I guess, away from the macro environment and to earnings that are currently underway, which it's retailer season right now, as a lot of the publicly traded retailers are reporting their earnings. Cole, what was Home Depot saying, and what you pick up from their call?
Yeah, I think this one's important to pay attention to. The stock is watched really closely by a number of analysts to gauge the health and habits of the consumer, right? Home Depot, I think, can be considered somewhat counter-cyclical in that if you aren't planning to purchase a home, you might be looking to redo your current one. But in this kind of overall environment, we've gotten a lot of interesting signals about what's going on with the consumer from some of the pieces I called out from their call. So Home Depot did kick off kind of this wave of retailer earnings. They reported their second quarter results on August 13th. I would assume most of our listeners know about Home Depot, but to give you some quick stats, just to talk about how kind of enormous of a retailer they are. They're certainly the largest one in the United States. They have 2,300 locations, spanning more than 230 million square feet of retail space, so not an insignificant amount of CRE. They have an estimated 17% market share in the US for various home improvement goods. But they make sure to point out on the call that it's an extremely fragmented market because there are so many small mom and pop hardware stores and other competitors in the space. They actually did beat consensus expectations on earnings and sales, but said that they expect same-store sales to decline 3 to 4% for the rest of the year relative to 2023. So they have continued to actually see negative same-store sales growth since the end of 2022. And I don't think it's too difficult to see why. That was the beginning of the rate hiking cycle. And so as the housing market continues to slow down, Home Depot struggles a little bit. But there's also another aspect to that, and that's that during the pandemic, they were kind of seeing all this pulled forward demand. And now they're kind of coping with a return to what might otherwise be a normal level of spending for home improvement goods. They did mention on the call that operating expenses ticked up 65 basis points. They have seen big ticket item spending continue to weaken. So their definition is $1,000 plus items. So think about appliances or kind of other major fixtures. And they were actually down, spending on those items was down 5.8% year on year in the second quarter. I would say there were a few bright spots. They have seen a steady increase in online sales. They have seen some reductions in transportation costs and shrink, which I think is code words for various loss, either items being stolen or items that go missing. But those costs are lowering, so that was kind of a bright spot for them. Interestingly, though, that there was a lot of commentary on this call that alluded to what's going on with the housing market and what might happen with if rates were to come down. So they have seen reductions, or the stat that they've cited is that housing turnover is down 40% to a nearly 40-year low. Executives on the call do expect to see more activity and more sales as mortgage rates approach 6%, which they expect to be at some point later in the year, unless the reason rates are lower is an economic downturn, which I think is something we've talked about many times on year. They say their customers are very concerned about the macro environment. They are seeing what they call deferrals of home improvement projects, folks who wait to bring on some of these large renovation projects until there's more clarity on where the economy is going to be. But I think that the other thing that's worth calling out here is they don't just sell to individual consumers. Home Depot also has a kind of professional business unit that sells directly to contractors. It's called HD Supply. Interestingly, they reacquired this business back in 2020. They do not break out this business in their earnings, but they mentioned repeatedly on the call that they've seen huge growth in this category. They also are kind of doubling down on this. They purchased or acquired SRS, which has a focus on roofing and pools. And I thought that was kind of an interesting hedge because who pays for most roofs? Well, insurance companies, not the direct consumers. And who pays for pools? And that's wealthier consumers. And so if they're expecting this kind of carving out in the middle, but they expect the roofing and pool business to do quite well, that might signal a little bit about where they're seeing the rest of this market go. So I thought this was a really interesting call, give a lot of good insight into the consumer and housing market. It's definitely tied to a lot of the stuff that we touch. But that was not the biggest call last week. I know that you paid attention to Walmart. What was going on with that one?
Yeah, so another massive retailer that is watched not only by analysts and investors, but I would say the market as a whole to really gauge how the U.S. consumer is doing. Walmart held their call on August 15th and reported slightly better than expected results for the second quarter. The company reported revenues that were generally in line with analyst expectations, but better than expected margins, which resulted in an overall higher than expected net income and approximately a 3% beat on their earnings per share for the quarter. Also notable from the call, the company's management issued guidance for Q3 net sales, which is now expected to be between 3.25% and 4.25%. And raised its full-year outlook on operating income, which it expects to grow between 3 and 4.5% for the year. Shares of Walmart really jumped more than 7% on the day of the call. And while these results are positive by themselves, they were received even more positively by the market, given that many investors and market participants pay attention to this to Walmart's call and their results, really to see if there is any sort of sign of consumer deterioration. And so the fact that Walmart not only reported strong and consistent results and also upped their guidance, it was really taken as a very positive sign, not only for the company, but for the U.S. consumer as a whole. And that fed into the whole Goldilocks scenario narrative playing out in the market. And another, and I would say more minor note, or one thing that jumped out on the call that I thought is worth sharing was the company's stated use of AI. I know that's a hot topic. It seems to be, maybe cooling off or getting a little bit of questioning around, but Walmart mentioned that they've implemented Gen AI into their search feature, which helped some pretty impressive double-digit e-commerce growth across at least their Sam's Club business, but more broadly contributed to their improving margins. But they also put a number on this that helps really demonstrate the potential of AI, even if it's not necessarily with the NVIDIAs or the chip or in any of the tech space, but in the non-tech space. So they said that the Gen AI that they've implemented into their search to get the same results without Gen AI would have been about 100 times more expensive to do. And so to me, this is putting a 100x multiple or multiplier on any sort of implementation of technology. That's huge, right? Even if it's not the main business that they are selling, but it is hugely efficient, and it becomes an efficiency gain for the company that not only saves costs, but it also improves profitability. And again, even if this is not a tech company, I think that this is a good demonstration of the potential profitability that can be unlocked with the technology and can really I would say improve the economy in a very significant way, even if it's not necessarily in the most obvious. And so I thought it was, there are lessons from Walmart that I think could be learned from other non-tech companies. And now turning attention to commercial real estate, we recently closed out our Q3 industry conditions and sentiment survey. And while the full release and all of the results really won't be shared until the end of September, we did want to give some a sneak peek and some initial takeaways from the results. Cole, I know you've been living in the data, so what have you seen so far, and anything that jumped out that you want to share with the audience?
Yeah, I've really enjoyed taking a look at this data so far, and there were really big, two big takeaways that I think are worth mentioning to kind of set the stage for some additional market commentary we've got here. But first was on the subject of capital availability. So we asked respondents to effectively rate expectations for 10 different categories of debt and equity capital providers on like a 12-month forward-looking basis. So asking, where do you expect availability to be within the next year? And sentiment can range anywhere from not at all available to extremely available. And we can translate this measure into a net expectation for capital availability. So your extremely or very available capital, responses minus those who expect it to be not very or not at all available. So my big finding here was that there were massive positive shifts in expectations relative to Q2. Every single category gained in the double digits percentage point wise, with the exception of PE and hedge funds. They increased kind of a net 9 percentage points. And I'll mention there wasn't a lot of room for them to grow. People expected them to be fairly available as is. And so I wouldn't have expected a huge jump here anyway, but 8 out of 10 categories of capital providers have now jumped into positive net expectation territory. The 2 exceptions remain banks and mortgage REITs, which I'm not too surprised to see that. I think banks are still sitting at around negative 22%. And what was really interesting, though, is that the biggest jump was with pension funds and endowments. So a net negative 16% expected them to be available within the 12 months following Q2, but a net positive 13% expect them to be available in the 12 months following Q3. So a huge improvement of 29 percentage points. And that was the biggest shift out of all the capital providers. So a lot of interesting stuff to unpack in there, but I think as rate cuts are becoming a lot clearer and folks are expecting the market to improve a bit and price discovery to pick up, that capital is looking to come off the sidelines, or other participants in the space think capital is ready to come off the sidelines. That was my one big takeaway. Lot more that'll be there once we put out the full report. But I did want to tease one other item, and we took a look at property type performance. So this is asking folks to bucket property types into sort of if they will perform at best or worst. So capturing their extreme opinions on a number of various property types. And you're not allowed in our survey to put them both in each. But there were some interesting things that came out of this. The outlook for industrial is waning a bit. So this was the 3rd consecutive decrease in the percentage citing that sector as performing best. So it slipped 9 percentage points on the quarter from 67 to 58%, saying it would perform best. Multifamily sentiment, on the other hand, has quickly rebounded. So at the beginning of the year, there were a lot of stories about potential multifamily distress and the oncoming wave of supply in select markets. But 69% say that the sector will be among the best performing asset types. And that is an improvement of 24 percentage points. So a huge rebound. Now, relatedly, the percentage citing multifamily as a potential worst performer actually dropped 11 percentage points. So from 21 to 10%. So if you think about that on a net basis, massive swing in favor of multifamily. Now, there was some concern about the consumer popping up, I think, in those numbers for retail and hospitality. The percentage citing as a potential best performer was down negative 16 or down 16 percentage points and down 8 percentage points. Those citing them as best performers were down that much. However, those citing hospitality and retail as the worst performers potentially were relatively flat. So not as big of swings as you saw with industrial and with multifamily, but a percentage saying that they will be best performers is down a little bit. The last item, and I would regret not calling it out, office saw very little improvement, but it was improvement. 85% say it will be among the worst performing sectors, but that is down from 93%. So down just 8 percentage points from Q2. So there wasn't a lot of room for opinions about office to get worse, but they did get a little bit better. And so I thought that that was super interesting. We'll see what happens in the next quarter. I'll be curious to know what happens with office, but definitely a lot more in that report. And I look forward to sharing a lot more items when we do kind of the full Q3 run through after we release the report at the end of September. But Omar, I hope that sets the stage for you a little bit for what's going on kind of in the market. Where would you like to start? It's an exciting time, a lot going on. What's the backdrop for the markets right now?
Yeah, so given that it is an exciting time, we wanted to take a moment to just highlight try to make sense of what we're seeing and what we think. And so I think we'll start at the macro level. I think that there really are kind of 5 forces and themes that are playing out that paint the backdrop for commercial real estate. So first, you have a cooling economy in terms of cooling inflation, but also cooling growth. Then the second is you have asynchronous monetary policy reversals, and this is by central banks across the globe. Of course, on this podcast, we're predominantly focused on what's happening at the Fed, but across the globe, you've already seen rate cuts, minus Japan, and those are having big impacts on the market. The third theme is really the swinging market sentiment. And this is in reaction to either new narratives or old narratives being tested, as well as monetary policy really flowing through and kind of disrupting what people think is going to happen and when it's going to happen. The fourth theme at the macro level, I would say, is political noise and real tensions, both of which are really rising within borders and across borders. And then the fifth theme is really this normalization. This is something that we thought coming into this year, normalization would very much be a theme, and I think it is playing out, but it's normalization to the longer term historical trends, yet these are trends that we really haven't seen for 5 years at least. And so even though you can say normalization, it feels like a lot of change.
So with those 5 things in mind, where do you think this leaves commercial real estate?
Yeah, so in one word, I would say choppy. But to elaborate, I would say it's not all good. It's not all bad. I think looking back at that 2015 to 2020 pre-pandemic period, our current vantage really makes, or So in one word, I would say choppy. It's not all good. It's not all bad. Looking back at the period that was pre-pandemic, so from 2015 to 2020, it really looks like picking winners and avoiding losers in CRE may have seemed easier than it is today, and that's because first, hindsight's 2020, but also perhaps because there was a greater sense of stability, or at least more steadily trending demand, more stable supply. But I think that a lot of that stability has really come under question recently. And we're seeing this really play out throughout commercial real estate, and driving a number of changes that we'll continue to monitor, not only through our surveys, but through these podcasts. And the first of those themes, I would say, is shifts in capital allocators' sentiment and intentions. So as Cole noted, and the ICSS, or the Industry Conditions and Sentiment Survey, really goes to capture what people are planning for, how they're feeling about the current environment. But then our data also supports what's actually happening. And what we can see is that CRE sentiment is really swinging with the broader capital market conditions. And while there have been signs of improvement in CRE sentiment, it hasn't really yet materialized. Much of the positive sentiment that we've seen is tied to rate cuts and hopes of rate cuts. Yet it's important to realize that deep, rapid rate cuts, or the type that many in the CRE space are hoping for or vocalizing, a desire for, often come with some sort of unfavorable economic backdrop. So rate cuts by themselves are not always indicative of good or better times to come. Another major theme that is in the CRE space is that capital availability, capital cost, and the demand for capital need to all be taken together and understood. So if interest rates do start coming down, that means that the cost of capital may be coming down, and one would expect the demand for capital perhaps to increase. However, you got to bring the availability of capital into this equation. The availability of capital is critical, because if capital is unavailable, that's pretty much equivalent to saying that the cost is infinite. And so while we watch the next couple of quarters play out and the start of the highly anticipated rate cuts, we got to keep watching not only demand, the cost, but also availability, because we have over 1.5 trillion in CRE debt coming due through the end of 2025, which means there's definitely a demand. Hopefully the cost will come down, but the availability, I think, is going to be a key area to watch to really understand the true health of CRE markets. Another major theme, I would say, is really the delayed distress and uncertain resolution of U.S. banks' CRE exposures. So yes, in 2022, when many were looking at the maturity schedule across the CRE space, there was a lot of commentary around how 2024 was going to be a kind of a cliff year. But a lot of those maturities have really been pushed out, and we haven't seen a massive amount of distress come in the bank space, and that's largely due to lots of loan modifications, which you see through they're called TDRs, or troubled debt restructurings, as well as potentially underreported distress, which could be attributable to either stale or outdated marks. But the pressure with which CRE exposures are really putting on U.S. banks has really not lessened, and I would argue it has increased, even though it's not necessarily seen through a lot of the data. But you do see this coming through because the banks have not yet returned to financing new deals or refinancing existing deals in a very meaningful way. And yes, you can. I think the survey insights that you just shared show that many are not expecting the banks to return in a very meaningful way, and this is important because whether you like it or not, like, the banks still have this outsized footprint within the CRE space. So we need to see some sort of resolution come through, or a significant change of the environment that would really alleviate that problem. A fourth theme I would call out has to do with the adjustment of expectations and practices in underwriting and valuation. So while the macro and market environments remain pretty uncertain, another element that's adding to the choppiness for CRE is because it looks less and less likely that we're going to return to a world of what I would call 4-3-2 anytime soon. And I say 4-3-2 because I think 4% represented the approximate cost to borrow. And it was often the underwritten kind of prime cap rate, right? So a 4%, you have a 4 handle on that. The 3 is generally what we were underwriting, and many lenders as well as investors were underwriting their revenue and NOI growth to be at stabilization. And 3% is also the long run equity risk premium. Both of those are out of whack. And then 2 being 2% as the underwritten expense growth, and ultimately the kind of expected long-run inflation and long-run kind of GDP or real GDP growth in the broad economy. So that 4-3-2 scenario is an environment that we had been living in from 2015 to 2020. Then things got all out of whack, and I don't think that we're going back to that 4-3-2 world necessarily anytime soon, which means that the amount of I would say customized underwriting and extra due diligence needed on assets is it's only going to really increase because you have to better understand how a property can perform in the market in a macro environment where these I would say assumptions are going to be tested. And the final theme I would highlight for commercial real estate is really that there's diverging performance across markets, sectors, strategies, and managers. So the choppiness for CRE will materialize in a really a wider variation of performance and returns across markets, sectors, strategies, and managers. Already you can see a clear divergence between big and small taking place. You see this coming out in the indices that are observable. Generally, the indices are tracking higher quality and bigger institutional ownership, and they seem to be performing much better. There have been a number of calls for having either found or nearing the bottom, but that doesn't necessarily represent the broader CRE universe. You got to remember a lot of CRE is owned by non-institutional owners, and it might not be, or a lot of it's not top quality. And while this divergence will, I think continue to play out, it's not necessarily a bad thing. You can put on the optimist's lenses and see this as an opportunity to either get in and buy cheaper, but it also has the potential possibility of really kind of reshaping the leaderboards or and shifting market share and the overall market makeup. We've already seen this come through with niche sectors gaining more popularity, but I think that it potentially may take a few more years to play out, but in the meantime, we might see more and more signs of divergence leading to a real shakeup. So those are, I think, themes that we're absolutely watching. I know that was a little bit of a monologue, but hopefully that brings in some of the macro and market trends that we've been following and help really solidify what we're paying attention to going forward.
Well, I know we've got a piece that's, by the time this will be released, it'll already be out, actually on Fed rate cuts and whether or not that's going to help revive the U.S. CRE market. So I do want to call that out. I'm sure we'd be happy to put that in the show notes for folks. But we've also got a couple other things going on. We'll be doing a podcast here soon with Rich Hill at Cohen & Steers, giving a good idea of what's going on in the CRE investment space, I think to shed some light on some of the other topics that you were just talking about. And then maybe one last thing is that we've got the Industry Conditions and Sentiment Survey, like I mentioned, will be released at the end of September. But Omar, those are kind of some big things that we're working on. What are some upcoming items here in the next few weeks that folks should be paying attention to?
Sure. So I'll do a quick rundown. So in terms of macro releases, on Friday the 23rd, we have new home sales. And then coming up the following week on the 29th, we have advanced goods and the trade balance data being released, as well as quarterly GDP and quarterly PCE data coming out. But then, as we noted, we're in the midst of earnings for retailers. And so I would pay attention to Nordstrom on the 27th, Kohl's and Five Below on the 28th. And then on the 29th of August, we have Best Buy, Dollar General, and Ulta Beauty hosting their calls.
Well, it's going to be a busy few weeks, but I'll certainly tune into a few of those. Maybe we'll talk about them on the next podcast. But I think that is all the time we've got for today's. But before we sign off, I did want to share with our listeners, just like I did on the last episode, how they might be able to give us some feedback on the show. If you'd like to leave us a message or feedback via voice recording, check out the show notes. You'll find a link that'll you'll be able to do so. I'd also encourage you to rate and comment on the show the old-fashioned way. So on your preferred podcast platform, or just send us an email, altusresearch@altusgroup.com. We would love to know what topics you'd like covered on the program. So please feel free to send us a note. But in the meantime, Omar, it's been a pleasure, and I look forward to speaking with you on another episode of CRE Exchange. Have a good one.